In finance and investment, it's really important to look beyond just the profits a company reports, because those numbers can be affected by accounting rules that don't show the true cash a company has available. Free cash flow is a better way to see how much actual cash a business generates after it pays for the things it needs to keep or grow its operations. This cash is what a company can truly use to pay investors, pay down debt, reinvest in the business, or keep for flexibility. Free cash flow is key for making smart financial decisions because it reflects real cash generation. There are two main ways to look at free cash flow. One shows cash available to all capital providers, including debt and equity holders, and the other focuses on cash available only to shareholders after paying debt. Understanding these concepts helps in evaluating a company's financial health more accurately. Free cash flow to the firm is the most commonly used measure in business analysis because it serves as the foundation for enterprise valuation models like discounted cash flow or DCF. It provides practical value in several ways. First, it acts as an indicator of financial health. When free cash flow is consistently positive and growing, it shows the company is financially strong and operationally efficient. While negative free cash flow isn't always a red flag, persistent negativity can indicate financial stress. Second, free cash flow forms the basis of valuation in finance, offering a more reliable long-term measure than earnings because it reflects actual cash generated. Third, management uses free cash flow to make capital allocation decisions, such as reinvesting in the business, paying dividends, buying back shares, reducing debt, or making acquisitions. Fourth, lenders look at free cash flow to judge a firm's ability to meet debt obligations, where strong free cash flow can improve borrowing capacity and lower financing costs. Finally, free cash flow helps evaluate operational performance by showing whether reported profits are translating into real cash generation, giving a clearer picture of true efficiency. This makes free cash flow analysis essential for sound decision-making in business. Free cash flow analysis is based on extracting key figures from a company's financial statements, starting with free cash flow to the firm, or FCFF. This is calculated by taking the operating cash flow, which is the cash generated from the company's main business activities adjusted for any changes in working capital, and subtracting capital expenditure. Capital expenditure represents the cash spent on maintaining or purchasing long-term assets like equipment or technology. Working capital changes are important to consider because if working capital increases, it uses up cash, while decreases free up cash. Another important measure is free cash flow to equity, or FCFE, which is similar to FCFF but adds net borrowings to the calculation. This reflects cash available to shareholders since borrowing raises cash that can be returned to equity holders. This particular measure is especially useful when assessing dividend-paying companies or valuing equity. Technology companies often generate a lot of cash from their operations while spending relatively little on capital investments. This allows them to have strong free cash flow, which they can use for buying back shares, paying dividends, or making strategic acquisitions, even if their accounting profits don't look very high. On the other hand, industries like airlines, utilities, and telecommunications require heavy investment in equipment and infrastructure, which can lead to low or unpredictable free cash flow despite being profitable. In retail and consumer goods, companies aim for stable free cash flow that can consistently support dividend payments, and analysts pay close attention to how free cash flow matches up with those dividends to judge sustainability. Private equity firms, when looking at potential acquisitions, focus heavily on free cash flow since it indicates a company's ability to repay debt and invest in growth. Overall, free cash flow is central to business strategy because companies with strong free cash flow can fund their growth without relying too much on outside financing, and improving free cash flow is often a key goal during restructurings or turnarounds. This makes free cash flow a critical measure beyond just looking at profits. Sustainable free cash flow is crucial because it supports long-term value creation and drives total shareholder returns. One major advantage of free cash flow analysis is that it's a cash-based measure, so it reflects real cash generated rather than relying on accounting estimates, which makes it more dependable. It's also closely tied to valuation models used in finance, especially discounted cash flow techniques, making it highly relevant for assessing intrinsic value. Another benefit is that free cash flow allows for better comparisons across different companies, industries, and time frames, providing more consistent insights than traditional earnings. Additionally, it gives a clear picture of sustainability by showing whether profits are backed by actual cash generation. However, free cash flow has some limitations. It can be quite volatile, influenced by one-time capital expenditures or changes in working capital. Interpreting it can be tricky too, since negative free cash flow might indicate strategic investments rather than poor financial health. Finally, how capital expenditures are classified can affect reported free cash flow, which involves a certain degree of accounting judgment. Overall, while free cash flow analysis is a powerful tool, it requires careful consideration of these factors to understand a company's financial performance accurately. Focusing too much on free cash flow can sometimes lead to short-term thinking, where management might prioritize immediate cash returns over investing for the long run. It's important to remember that while free cash flow shows true cash generation, it can be volatile and doesn't tell the whole story on its own. Other measures like net income, EBITDA, and operating cash flow each have their strengths and limitations. Net income reflects profitability but depends on accounting rules. EBITDA shows operating performance but ignores capital expenditures, and operating cash flow highlights core operations yet doesn't account for asset investments. Using free cash flow together with these other metrics gives a fuller, more balanced view. Ultimately, free cash flow analysis is a key tool that offers a clearer picture of a company's true economic health and financial flexibility. When used thoughtfully alongside other indicators, it helps organizations make better decisions about valuation, capital allocation, and strategic planning. Although it has its challenges, especially due to volatility, businesses that actively monitor free cash flow are typically better equipped to grow sustainably, handle downturns, and create long-term value for shareholders. In today's world where liquidity and flexibility matter more than ever, free cash flow analysis remains a fundamental part of smart financial management.